645,000 people. That's the entire population of 401k millionaires in America, out of roughly 133 million households. Put that number inside a box and hold on to it, because in the next few minutes I'm going to break that box open and show you exactly what's inside it. Compare these two people for a second. On the left, someone at a class reunion telling you their brother-in-law retired with $4 million sitting in his account. On the right, you, driving home, opening your own statement, feeling that punch in the gut. Here's what neither of them is telling you. The number of 401k millionaires peaked right here in late 2025, and then it dropped straight back down in the first quarter of 2026. Even the so-called millionaires aren't as stable as the headlines make them sound. By the end of this video, you're going to know exactly which of three groups you fall into. And the surprising part, the twist nobody covers, is that the person with 1.2 million can end up worse off than the person with 700,000. I'm going to show you the exact mechanism that causes that, step by step. Let's start with the brain lie, because before we touch a single number, we need to understand why this topic messes with your head in the first place. When you hear the word millionaire attached to retirement over and over, in headlines, in comment sections, at reunions, your brain quietly recalibrates what it thinks is normal. This is a well-documented pattern in behavioral economics. Researchers call one piece of it anchoring, where the very first number you hear becomes the invisible ruler you measure everything else against. Another piece is called the availability heuristic, where the examples that come to mind easiest, the loudest bragging voice at the barbecue, feel more common than they actually are, simply because they're memorable. Neither of those mental shortcuts has anything to do with what's actually typical. They just feel true because they're loud. So let's replace loud with accurate. Stack these numbers on top of each other and watch what happens. As of the most recent Fidelity data through the fourth quarter of 2025, there were roughly 665,000 401k accounts with $1 million or more inside them. By the first quarter of 2026, after a stretch of market volatility, that number dropped by about 3%, down to around 645,000. Sit with that for a second. The Millionaire Club itself shrank in a single quarter. That's not a typo and it's not a one-time event. It's proof that hitting 1 million isn't a finish line you cross once and keep forever. It's a moving target that people fall in and out of, quarter to quarter, depending on what the market is doing underneath them. Now compare that to IRA millionaires over the same window. Roughly 571,622 IRA accounts crossed the $1 million mark in the first quarter of 2026, which is actually up around 32% year over year, even during the same stretch that 401k millionaires were falling. Draw a line from that 401k number to this IRA number and notice the gap. Two different account types, exposed to the same market, moving in different directions, because of differences in contribution timing, rollover activity, and how each pool of money is invested. The lesson underneath all of it is the same one. Any single snapshot of who's a millionaire is a photograph of one moving object at one instant, not a permanent portrait. Here's the number that actually matters more than any millionaire headcount. Stack these two bars side by side. The average 401k balance in the first quarter of 2026 sits around $141,000. The median, the number right in the middle where half of savers have more and half have less, sits around $32,800. That gap between the average bar and the median bar is the entire story of this video in miniature. A relatively small number of very large accounts pull the average bar way up, while the median bar tells you what's actually typical for the person sitting next to you at your job, your church, or your own kitchen table. One quick honest note here, because I want you trusting every number in this video. The Federal Reserve Survey of Consumer Finances, the deepest, most detailed look at household wealth in America, only comes out roughly every 3 years, not every quarter. So when you compare a Fed number to a Fidelity number, you're sometimes comparing a slower, 3-year snapshot to a fast-moving quarterly one. Most creators blend these together without saying so. I'm telling you so, because it matters when you're deciding how much weight to put on any single statistic. Here's a number fully inside your control, unlike the market. The total 401k savings rate, meaning what employees contribute plus what employers match, recently hit a record high, somewhere around 14.2 to 14.4% of pay. Watch this number climb over the last decade, and understand why it matters more than any single account balance snapshot. Your balance depends partly on the market, which you don't control. Your savings rate depends entirely on you. Let's turn the timeline itself into a picture. Phase 1, the first 10 years of saving, where compounding is invisible, your balance barely seems to move no matter how disciplined you are. Phase 2, years 10 through 20, where compounding becomes visible, the account finally starts growing faster than your own contributions alone would explain. Phase 3, year 20, and beyond, where compounding does the heavy lifting almost entirely on its own. The average 401k millionaire is around 59 years old, with an average tenure of about 25 years in the same plan. That's not luck. That's phase 3, playing out exactly as it's supposed to, for people who stayed the course long enough to get there. Now let's put you into one of three groups, live, right now, so this stops being abstract. Group A, $1 million or more in retirement accounts and investments, not counting your house. Group B, $300,000 to $1 million. Group C, under $300,000. Be honest with yourself about which rung of this ladder you're standing on, because each group has a completely different set of risks hiding underneath the surface. Let's start with Group A, because the twist I promised at the very top happens here. If you've crossed $1 million, you're in the top 3 to 5% of savers, and the entire game changes the moment you cross that line. It stops being about growth and becomes entirely about protection and extraction. Here's the first hidden trap almost nobody explains clearly. Required minimum distributions, under the rules known as Secure 2.0, currently force you to start pulling money out of most retirement accounts at age 73, whether you need the income or not. That forced withdrawal gets added on top of your other income, and it can push you into a much higher tax bracket than you expected. Here's the second, more dangerous trap. Picture a cliff, not a slope. Medicare charges higher earners an extra monthly surcharge called IRMAA, and it doesn't rise smoothly. It jumps in sharp steps based on your income from 2 years earlier. Cross a specific income threshold by even one single dollar, and you can trigger thousands of dollars in extra Medicare premiums for an entire year, for you and your spouse both. This bounded section of the tax code catches more retirees off guard than almost anything else in Group A, precisely because it looks like a gentle slope until you're standing at the edge of the cliff. Now here's the mechanism behind the twist I promised you at the very beginning: sequence of returns risk. Picture two retirees, both starting with exactly the same $1 million, both averaging the exact same 7% return over 20 years. The only difference between them is the order those returns arrive in. Retiree 1 gets strong returns in the first few years of retirement, followed by weaker years later. Retiree 2 gets weak, even negative returns in the first few years, followed by strong years later. Even though their average return is identical, retiree 2, the one with bad luck early, can run out of money years before retiree 1, simply because withdrawals taken during a market downturn lock in losses permanently, leaving less money left over to recover when the good years finally arrive. This single concept, more than almost any other in retirement planning, explains why a $1.2 million portfolio can end up worse off than an $800,000 one. It was never really about the size of the number. It was about what the market was doing during the first 5 years someone started pulling from it. One more advanced tool worth knowing if you're in Group A. In the gap years between when you stop working and when required distributions begin, your taxable income is often unusually low. Some retirees use that low income window to convert a portion of a traditional IRA into a Roth IRA, paying tax on that conversion now, at a lower rate, so that money and all its future growth comes out completely tax-free later. This is genuinely advanced territory, and the right amount to convert depends entirely on your specific tax situation, which is exactly the kind of decision a licensed advisor should walk through with your real numbers, not a video. Now Group B, 300,000 to 1 million, the quiet majority. If you're sitting anywhere in this range, compare yourself to the national median we discussed earlier, not to the loudest voice at the reunion, and you're already outperforming most households by 2 to 3 times over. Let's deepen the levers here. Social Security offers a guaranteed increase of about 8% per year for every year you delay claiming between your full retirement age and age 70. Stack that against anything the market has reliably offered over that same short window, and you won't find a comparable guaranteed, inflation-adjusted return anywhere else in the financial world. That's not a sales pitch. That's simply how the benefit formula is built. As you approach retirement in this range, consider what planners call a bond tent, a temporary increase in safer, more stable investments in the years right before and right after you retire, gradually easing back toward more growth-oriented investments once you're a few years in. Picture it as a tent shape on a chart, rising to protect you right at the most vulnerable moment, then sloping back down once that danger window has passed. Now Group C, under 300,000, and this is where most other channels stop giving you anything real. Let's fill that gap properly, with actual numbers instead of general encouragement. Working 3 additional years does 3 things simultaneously. It adds 3 more years of contributions instead of withdrawals. It shortens the number of years your savings need to stretch across. And it can meaningfully raise your Social Security benefit, since your benefit is calculated from your highest 35 years of earnings, so replacing an early, lower-earning year with a later, higher-earning one raises the average your check is based on. Layer those 3 effects together, and 3 extra working years can shift your retirement math by far more than 3 years of investment growth alone ever could. If you're a lower-earning spouse, or you've never worked outside the home, spousal Social Security benefits allow you to claim up to roughly half of your spouse's full benefit, even with little or no earnings record of your own. And if you're widowed or divorced after a marriage of at least 10 years, survivor and divorced spouse benefit rules can provide meaningful guaranteed income that almost nobody in this genre of content ever walks through clearly. If this describes your situation, this is exactly the kind of coordination question worth bringing directly to the Social Security Administration or a fee-only advisor who specializes in claiming strategy. One more tool specifically for late starters still working. A health savings account, if you have access to one through a high-deductible health plan, functions like a stealth retirement account. Contributions go in tax-free, growth is tax-free, and withdrawals for qualified medical expenses come out tax-free too, at any age, with no required distributions ever forcing money out. For a viewer in their late 50s or early 60s still working, this is one of the most underused accounts in the entire tax code. And if you're self-employed, a freelancer, or working gig-based income without access to a traditional employer plan, don't count yourself out of this conversation. A SEP IRA or a solo 401k can allow contribution limits well beyond a standard IRA, specifically built for exactly your situation. Let's talk about the difference between being house rich and retirement rich, because this single distinction changes how every number in this video should actually feel to you. Picture 2 people side by side. One has a $900,000 home, fully paid off, and $100,000 in investments. The other has a $250,000 home and $750,000 in retirement accounts. Same $1 million net worth on paper. Completely different retirement reality in practice, because one of those numbers can be spent monthly, and the other one is sitting quietly in the walls around you. For homeowners sitting on significant equity but limited liquid savings, a reverse mortgage, formerly called a home equity conversion mortgage, is one option worth understanding honestly, both the benefit and the risk. It allows a homeowner over 62 to convert home equity into income or a line of credit without selling the home or making monthly mortgage payments. The honest trade-off is real closing costs, ongoing interest that accrues against the loan balance, and a reduction in what's eventually left for heirs. It is not automatically predatory, and it is not automatically the right answer. It is a tool that fits a narrow set of situations, and it deserves a full conversation with a fiduciary advisor before anyone signs anything, never a decision made from a single video. Downsizing offers a cleaner version of the same idea. Sell a larger, more expensive home, move to something smaller or in a lower-cost area, and the difference in price can convert directly into an investment or income-producing asset. One detail worth knowing: the tax code allows an exclusion of capital gains on the sale of a primary residence, up to $250,000 for a single filer or $500,000 for a married couple filing jointly, under specific ownership and use requirements. That exclusion can make downsizing arbitrage even more powerful than it first appears on paper. Location plays its own quiet role in this same equation. Some states charge no state income tax on retirement income at all, while others offset that with higher property taxes or other costs elsewhere. There's no universal answer here, only a specific comparison worth running for your specific state, your specific home value, and your specific income sources, ideally with a tax professional who knows the details of wherever you're considering. Let's move into the leaks that quietly drain a retirement plan that looks perfectly healthy on paper. Medicare itself has moving parts most people don't fully understand until they're already inside the system. Part A covers hospital care. Part B covers outpatient and doctor visits. Part D covers prescription drugs. On top of that foundation, retirees generally choose between a Medigap supplemental policy, which usually costs more monthly but covers more of the gaps, or a Medicare Advantage plan, which usually costs less monthly but comes with a narrower network and more out-of-pocket exposure if you get seriously ill. Neither choice is universally right. It depends entirely on your health, your preferred doctors, and how much monthly cost versus potential future exposure you're comfortable carrying. Long-term care is the leak most families never budget for at all. Realistic cost of care estimates for a nursing facility or extended in-home care can run into the hundreds of thousands of dollars over a multi-year stay, and Medicare covers very little of it. The honest menu of options here includes self-insuring, meaning setting aside a specific pool of assets earmarked for this exact possibility, a hybrid life insurance and long-term care policy, which combines a death benefit with a long-term care rider, or Medicaid spend-down planning for those with more limited assets, which requires understanding your state-specific look-back rules well before you'd ever need to use them. None of these options is presented here as the right answer for you specifically. That decision depends on your health history, your family history, and your overall asset picture. One final advanced tactic worth understanding, especially if you retire before Social Security and required distributions begin. Those years often create a low-income window, sometimes called the gap years. Some retirees use this window strategically, either converting a portion of a traditional account to a Roth as we discussed earlier, or realizing long-term capital gains at a lower tax rate than they'll face once Social Security and required distributions push their income back up. This is high-value, genuinely underused territory in mainstream retirement content, and exactly where a few hours with a fee-only planner can be worth far more than the fee itself. Let's build your real number, using 4 questions instead of the usual 3. Question 1. How much guaranteed income will you actually have? Social Security for you and your spouse, any pensions, annuities, or other fixed income sitting underneath everything else. Question 2. What are your true fixed expenses? Housing, insurance, utilities, food, basic transportation, baseline health costs. Question 3. How much flexible, fun money do you actually want? Travel, gifts, hobbies, grandkids, home projects. And question 4, the one almost nobody asks, what's your margin for inflation and longevity? This means stress testing your plan against 2 uncomfortable questions at once. Could your plan survive a 25% drop in your portfolio's value during your first 3 years of retirement? And could it still hold up if you or your spouse live to 95? If the honest answer to both is yes, your plan has real margin built in. If the answer is no to either one, that's exactly where a conversation with an advisor earns its cost many times over. Before we close, one honest note, stated clearly rather than buried at the end. Everything in this video is general education, not personalized financial, tax, or legal advice. Your health, your tax bracket, your state, and your family situation are all different from the next person's, so before making any real changes to your savings rate, your Social Security claiming age, or your withdrawal strategy, sit down with a fee-only fiduciary advisor or a CPA who can look at your actual numbers. And one more thing worth saying plainly: no product, no annuity, no insurance company, and no specific advisor is being sold to you anywhere in this video. One last note, gently. If money stress from any of this is affecting your sleep or your health, that's worth mentioning to your doctor too, not only your advisor. Let's go back to where we started. 645,000 401k millionaires, out of 133 million households. For most of this video, that number probably felt like a wall keeping you out of a club. I want it to feel different by the time this ends. That number isn't a verdict on whether you've succeeded. It's proof that almost everyone is standing exactly where you are, quietly doing the math at their own kitchen table, regardless of which group they're actually in. Whether you're in Group A worried about taxes and required distributions, Group B quietly outperforming the median without realizing it, or Group C building a real plan for the first time with under 300,000 saved, the question was never am I a millionaire? The question is whether your plan can actually support the life you want, without you lying awake at night doing the math alone. If this helped you see your own number more clearly, subscribe so you don't miss the next piece of this series, where we take whatever number you actually have, and turn it into a real monthly withdrawal strategy you can depend on.